Budget 2018, the global view with me, Tanvir Gill. My guest today on the show is none other than Krishna Memani, who's the Chief Investment Officer at OppenheimerFunds, a global fund house that oversees nearly $250 billion in assets across regions. And he's here to talk about his outlook for 2018, to talk about India among emerging markets, and also to comment on his expectations with regards to the upcoming budget. Krishna, it's great to have you on the show. Thanks very much for taking out the time. Let's start by discussing your outlook for this year. In a well-written note, you've highlighted that we are nearing the end of this bull market cycle. We are getting closer, you say. How close are we time-wise? Because we are now in the 10th year of this mega bull run.
So it really depends on what the Federal Reserve does more than anything else. So right now we are going through a phase where every economy in the world is outperforming, effectively growing perhaps faster than where they could, their trend rate. If this continues, effectively the Fed would be forced into a situation where they tighten more aggressively than what the market is expecting today, or perhaps tighten more aggressively than what they would like to do. If that happens, the cycle is going to end sooner than later. Our expectation is that things start moderating by the second half of the year, and therefore the Fed becomes slightly less aggressive than what it is planning on doing today, and as a result the cycle extends. In any case, we think the likelihood is quite high that by 2019, late 2019 and early 2020, we start talking about a recession of some sort, but we shall see.
Krishna, what do we need to be most watchful of as a top indicator to sense that things are turning around or perhaps hitting the turning point?
Sure. So I think the risk this time around would come from one thing and one thing only, which is inflation manifesting itself in developed markets. If that happens, all bets are off. Effectively, that'll prove to all the central bankers that we are in the late stage of a recovery, and because rates are so low in a historical context and relative to whatever inflation ends up being at that point, I think they will have no choice but to press on things a little harder than they would like. So I think this time around, the risk is going to come from inflation as opposed to corporate defaults, because we are dealing with two very different situations. In 2007, 2008, it was a question of the global leverage cycle unwinding itself. We had levered the global financial system in a big way, and we needed to unlever that. And when that started, that brought in the down leg in the markets. This time around, what has to happen is inflation that has been missing in action comes back into the picture, and when that happens, the global easing cycle that we have gone through from the central bankers has to be unwound. So the two very different situations and two very different drivers.
In the note, Krishna, you talk about the impact of the tax reform. This mega tax cut, as you see it, is a sugar rush, according to you, that will drive us to a point of frenzy and overheated growth in the U.S. Do you view it as a mistake then?
Well, so I think if you assess tax reform from the standpoint of did the U.S. economy needed any more short-term stimulus to keep it growing, the answer is no. We were growing at a reasonably good pace and probably close to what the trend rate has been. So the tax reform actually added an oomph to the U.S. growth rate at a time when we didn't need that, and at a time when it can generate inflation. So from that standpoint, tax reform was definitely a mistake. Having said that, I think if you think in longer-term context, if tax reform leads to significantly higher level of investment and in turn leads to a significantly higher level of productivity growth, then it wouldn't have been a mistake. I don't think that is going to be the case, and therefore, I think the risk of inflation picking up because of growth rate being higher than what the economy can take at this point may end up being a problem. Again, I don't think that's how things work out. I think we will get an uptick in growth rate in the first half. In the second half, things start slowing down, and as a result, it would be a short-term boost to the U.S. economy, and then things level out. If I'm wrong, then the tax reform bill would have brought forward the recession because it'll force the Fed to act sooner than what it would have done otherwise.
Right. I'll tell you why I'm asking you that, because that seems to be sort of a trend in making across the world. In India as well, there's a view that the government may look to cut corporate taxes in the upcoming budget. Does it fit well for India given its growth cycle versus that of the US? I mean, does it make sense for the government to extend out another stimulus to the economy when it seems like, or data suggesting, that recovery is on its way?
So I think India and the U.S. are at two very situations in their, evolution. U.S. is a developed market, and the trend, potential growth rate that you have in the U.S. labor market, for example, is relatively modest. We have unemployment rate is near 4%. In India, the situation is the exact opposite. That is, the biggest challenge India has to generate growth, to kind of take advantage of its demographic strength. That is, India is adding, don't quote me on specific numbers, but somewhere around 7 million new people into the labor force every year. That can absorb a lot of new jobs. So I think if the government can do things to jumpstart growth in a meaningful way, that may not lead to an uptick in inflation, and that may end up being a really good thing for India. That is not the case in the U.S. because the potential growth rate is much lower than what it is in India, and the slack is just not there.
Right, but some argue, Krishna, that India should not tamper with its tax revenue receipts, especially when it's signaling to the world that it has control over its finances, and at a time when oil seems to be on the boil again. Do you agree?
Oh, absolutely. And again, let's kind of keep the longer-term perspective away from the cyclical situation. From a cyclical situation, Indian growth rate is actually slowing down. Tax collections that were supposed to come from GST and things like that, it may eventually pick up, but they haven't picked up much. And there is general concern that the deficits may go up some rather than go down. At the same time that oil prices are spiking up, and therefore the gift from oil prices that we had in 2015, 2016 will go away. So I think from a cyclical perspective, cutting taxes right now would certainly not be very helpful from a deficit standpoint. And given the fact that Indian growth is slowing down already, if you throw another kind of negative on top of that, I don't think that will help Indian markets or international investors' perspective of outlook for India.
That brings me to my next question, which is on oil prices. Crossing $70 to a barrel, do you think that's a worry for the world in 2018? It's been such a recovery in 24 months, from the time when oil tanked sub 30 in early 2016 to now. Do you think the demand-supply scenario will kind of extend oil prices on to 70 beyond, perhaps even talking about 100 soon enough? And is that a worry? Is that a risk that we need to contest with right now?
So I think the likelihood of oil prices getting to 100 in my mind is pretty remote because, again, the fact that shale can come up into production relatively quickly, I don't think that has gone away in any meaningful way. That is, there's plenty of capital available to those people, in a high oil price market. They will want to generate the cash flow to pay back the debt that they had taken on. So I think that is still hanging over the market. So I don't think it goes to 100. I think the likely scenario is that it is somewhere between, let's say, $60 price would be the number that I would hang my hat on, primarily because global growth is reasonably good. Emerging market growth is getting to a better place, and the energy intensity of emerging markets is significantly higher than developed markets. So that certainly helps. Oil prices.
The reason I ask you that, Krishna, is because India's worked with the assumption of oil around $70 for its fiscal math. Can burning oil prices derail the government's glide path of fiscal prudence? For an oil importing country like India, is oil our biggest risk in this year?
So I think that really depends on the policy that the government implements. So if the policy that the government implements, it starts going down the path of kind of sheltering consumers, sheltering the population from that rise in oil prices and subsidizes that, that will have a very negative impact on the deficit. And as a result, that will definitely have some negative impact on how international investors perceive India. It'll depend on the magnitude of that subsidy and whether the policymakers articulate that there's only certain amount of subsidy that they're going to provide. But at the end of the day, if oil prices go up, that is not a good situation for India. That's not a good outcome for India. That outcome can be managed a little bit if they don't go forward with providing further subsidy for oil prices.
Right. In your note, Krishna, you also spoke about the US dollar being stable or weaker. That's your outlook for the US dollar. Well, that's a bit of a conundrum because we are at 90 on the dollar index at a time when yields are at multi-year highs and growth is climbing back, plus equity markets continue to rally. Why is the world buying more gold, euro, pound versus a safe haven in the greenback? Explain this dichotomy.
Well, so it's really a question of where we are in the cycle. Coming out of the financial crisis, U.S. started growing growing fastest the first. And as a result, we are at an older point in the cycle in the U.S. than we are with respect to emerging markets or places like Europe. So as a result, I think what the dollar is telling you is growth is better in the rest of the world, and flows are going from U.S. investors to other parts of the world to harvest that growth rate. If that reverses itself, that means that overall growth in other parts of the world is slowing. U.S. cycle is already older, so that would bring forward the potential of the cycle ending sooner rather than later. So we watch the dollar the most. I think in this day and age, if you're watching one thing, it has to be the dollar. If the dollar starts strengthening meaningfully, I think the implications of that for asset prices is going to be quite negative.
You know, Krishna, I like this graph you showcased on China showing how speedily the transition to a services-led model has happened in just the last 4 years. Do you think China is big competition to markets like India that also derive a major revenue and a major chunk of their growth from the services sector? I mean, China may have peaked on the manufacturing side, but they are building a strong case to look like a domestic-oriented economy, an economy which is inward-looking. What would that mean for the world?
So, Chinese economy is going to be the largest economy in the world in not too distant the future. That being said, the risk with China is that over the last 2 decades, the growth rate has been very skewed. It has been driven by the large savings pool that they have, and that savings pool getting invested in sort of large manufacturing state-owned enterprises. If they had continued on that path, I think the growth rate in China would have had to come down meaningfully and for an extended period of time, just from the standpoint that they would have misallocated a significant amount of that capital, that savings pool that they have created over the last few decades. I think the surprise has been that the Chinese economy has started transitioning, and it is a slow process. But I think the data is quite clear on that transition has begun, and that transition has begun on both fronts. That is, the policymakers are implementing specific policies with respect to reducing investment. And at the same time, the Chinese middle class, the Chinese consumers, the Chinese service economy has been growing at a much more rapid pace than the overall growth rate in China. I was in China in December, and what I was kind of really surprised by was all the different e-commerce, new economy, service economy things that they are trying, and the sheer scale of that experiment. So from that standpoint, if China is successful in transitioning slowly but persistently to a service-oriented economy, I think it will be in a much better economic position. And if they are successful in doing that over the next 2, 3, 4 decades, I have no doubt it is going to be the largest economy in the world and the most important economy in the world, just because of sheer size, the population density, population density. U.S. With 300 million people as opposed to 1.2 billion people, it's just a different scale.
Let's talk about India then, Krishna. What do you expect from India's budget? 3 factors that you would watch out for as a foreign investor.
So I think this is our expectation is that the Indian budget would have a more significant political element in it than would have been the case 1 or 2 years ago, because you have an election coming up in not too distant a future, and things are softening from a political standpoint for the Modi administration. So, they clearly would do more infrastructure spend, support rural initiatives, and perhaps try other things. So, I think you'll see some of that in the budget. The other thing that we would be watching very keenly on the budget is things that we talked about. What is the net outcome from a fiscal standpoint? So GST collections have been very modest. Hopefully they pick up in a significant way. And oil prices are higher, and hopefully they don't they don't go too far higher from where they are right now. But that's something that FIIs are very worried about. If the deficit increases meaningfully because they have political initiatives and tax collection goes down, or oil subsidy increases, I think that will have a reasonable impact on the Indian growth picture from a longer term perspective. As far as the Indian markets are concerned relative to these budget considerations, I think two observations. One, Indian markets are benefiting not because of growth acceleration in India. The Indian economy has actually slowed down. What they're benefiting from is continued flows from foreign investors into emerging markets in general, and India happens to be a large emerging market. So that's one. And the second thing is the equitization of Indian savings. Effectively, Indian savers who were focused on putting their money in banks are putting their money in equities, and that's a longer-term, multi-decade situation. But the FII flows can turn around pretty quickly. So if the budget is significantly worse than what we expect, I think that will have some implications on foreign flows. It may not undo the rally in the market, but I think it may take the kind of the bloom off the rose a little bit.
Krishna, there's a lot of talk about long-term capital gains holding period being extended from 1 to 3 years. Also rumors of an LTCG being introduced, or STT for that matter. How would you react to such a development? What are your thoughts on tweaking the tax structure imposed on the markets right now?
So, what India needs more than anything else to kind of take advantage of its demographic advantage is capital. Anything the government can do to bring in more capital, facilitate capital formation in the U.S. economy, in the Indian economy, will be beneficial from a longer-term perspective. So any taxation on that front is a negative from a long-term perspective. Implementing policies that make capital formation easier, capital flows into India easier, I think will pay very rich dividend from a longer term perspective.
The rural economy and infrastructure will definitely be two segments that the government will be focused on in the upcoming budget. In fact, this budget is seen as an election budget in that sense, because we're going to be stepping into an all-important election season in the second half of this year. What do you expect the government to do with regards to ensuring that they push demand on the rural side of the economy, as also increase infrastructure spending?
So I think in infrastructure spending, if they have a significant initiative in infrastructure, I think that will assure foreign investors that the recent slowdown in growth in India is temporary, and the policymakers are implementing new policies to revive that growth. And I think that would be seen very positively by the investment community.
There have been scores of reforms: GST, demonetization, PSU banks recap, IBC being introduced, new FDI norms in retail and aviation. They're all good steps. The government, of course, is flexing itself and pushing itself on easing norms. Is that helping change perception on doing business in India? Because the government seems to be sending out the signal that they're open to new ideas that can work.
So I think from a capital inflow, capital allocation standpoint, dealing with the issue of NPAs in India is extraordinarily important. The initiative that the government has, I think, is a good step forward. The trick in all of this is in the execution. That is, you implement a policy, that's good, but what happens on the ground, on the back of that policy initiative, is really far more important. What do you do in terms of recapitalization? What do you do in terms of writing down bad loans and implementing policies so that this doesn't end up being a recurring phenomena for the banking sector? I think all of those are very, very important things. It's initial going on that front. There's a lot more work to be done from that perspective. I think the government has some really good and interesting ideas. They have taken some really bold initiatives and are in the process of implementing a lot of them. So I think things are moving forward. The challenge with India hasn't been coming up with new ideas, just that every so often they come up with these self-inflicted wounds that takes away from the momentum that the economy has on its own. And things like demonetization and a rapid implementation of GST would be the two best examples of that. Hopefully, they avoid those mistakes in the future and continue to implement all the new good policies that they have come up with and execute them expeditiously. I think that would be really game-changing for the Indian growth rate in the long term.
Indian bond yields have gone past 7%. Will it make the RBI review a rate hike sooner versus later? Or can India continue to be in a supportive rate regime even if the world exits, to support growth in earnings and also credit demand, which is picking up slowly now?
So, again, it's the action of the RBI is really going to be reactive as opposed to proactive. So I think core inflation on a worldwide basis, I think, is at a good place. On the other hand, if the Indian government implements policies where deficit is going up, oil prices spike up, and as a result, inflation in India picks up in a meaningful way, the RBI policy-making bodies would have no choice but to react to that. So, and rightly so. I think if inflation picks up in India in a meaningful way, I think that would not be a good outcome for the Indian economy in the long run. And tackling that issue in the near term will end up being quite important. So it really depends on what the government does. If they are more disciplined on the budget front, I think that there's enough slack in the economy and inflation has come down, and I think it remains stable. And probably the path for rates is reasonably stable, and India continues to grow and hopefully grows faster in not too distant a future.
Krishna, it's great to have you on the show. Thanks very much for taking out the time to speak with us all the way from New York. We really appreciate your views and your thoughts.
Yeah, thank you. Good talking to you.
Well, with that, we come to the end of this edition of Budget 2018, The Global View. Thanks very much for watching the show.